I'm very famous for saying never sell your Bitcoin. And that's why the internet went crazy when we said we might sell it.
For 6 years, the undisputed high priest of the Bitcoin network gave the global market a single, unyielding commandment. There is no second best, and you never, ever sell your Bitcoin. But behind closed doors, the math has finally broken the dogma. Michael Saylor, the man who weaponized corporate debt to swallow over 1% of the entire global supply, has quietly crossed his own Rubicon. This isn't a betrayal. It's a cold, calculated realization that the nature of the financial war has changed. When the ultimate maximalist alters his playbook, it doesn't mean the thesis is dead. It means the endgame has arrived, and the exit doors are being re-engineered for the elite. The mainstream financial press will look at recent corporate filings and see a simple, routine rebalancing. They will tell you that strategy is merely managing its debt maturities, optimization of cash flows, or taking standard profits to appease legacy shareholders who still view corporate balance sheets through the lens of traditional accounting. The surface narrative is comfortable. It frames this pivot as a sign that Bitcoin has matured into a standard, liquid corporate asset that can be traded, hedged, and trimmed like any other tech stock. It is a story of stabilization, designed to make you believe that the radical, volatile experiment is over and a peaceful institutional status quo has been reached. But the hidden story reveals an entirely different paradigm. Saylor hasn't lost faith in the asset. He has realized that holding a static stack of digital property is no longer enough in a world dictated by the everything code and weaponized liquidity cycles. The early defensive era of Bitcoin, where simply hoarding coins was the ultimate act of defiance, is over. We have entered the offensive era, where financial titans realize that static wealth is dead wealth. By introducing strategic liquidity and maneuvering his treasury dynamically, Saylor is transforming strategy from a passive vault into an active institutional central bank. The realization beneath the surface is chilling. You don't survive the coming currency debasement by just sitting on a pile of gold. You survive by becoming the entity that controls the flow of that gold when the legacy banking system goes dark. Listen carefully.
We want the market to understand that Bitcoin capital gains fund stretch credit dividends. So when we sell STRC credit, we sell $1 million of it. We turn around, we buy $1 million of Bitcoin. We expect Bitcoin to appreciate about 30% a year. It's been appreciating almost 40% a year. We strip the first 11% of that capital gain, and we pay that as a credit dividend. But there's been a bit of confusion in the market about where the dividends come from. How do we pay the dividend? And for most of the history of the instrument, we sold common equity, MSTR equity, to pay the dividend. MSTR equity is a derivative of Bitcoin. It normally trades at a premium to Bitcoin. And so we were selling a Bitcoin derivative. But some people worried that we wouldn't be able to sell the equity in the future. And then there are short narratives that we have to sell the equity. And then there are other narratives that the company won't sell its Bitcoin. And that kind of metastasized to, well, if they're not going to sell their Bitcoin, it must not have any value, and they can never sell it. And if they can't sell it, then we can't count the Bitcoin as an asset on the balance sheet. So if you had $65 billion worth of something and people wanted to value it at zero, it's not very good, right? We don't want the credit rating agencies to think the company has $0 of assets. We want the credit rating agencies to think we have $65 billion of assets. And, there are also trolls on the internet that continually complain that this is a Ponzi scheme because we sell equity in order to fund a preferred dividend. Well, what we want to do is we want to reinforce the business model is we sell credit to make a capital investment in an asset, Bitcoin, digital capital. The capital investment accretes over time faster than the dividend. We then monetize the capital gain and we pay the dividend. We think that the best way to punctuate this, to make it very clear, is to make the point that the company doesn't have to sell common stock ever. We can simply sell highly appreciated Bitcoin in order to pay a dividend. And if we do that, you're capturing a capital gain to pay a credit dividend. I think the analogy is like a real estate development company raises capital by issuing a credit instrument, buys land at $10,000 an acre, develops it, it's worth $100,000 an acre. and then they monetize that capital appreciation. You could sell the land at $100,000 an acre. You could rent the land after you fully developed it. You could refinance the land. But nobody questions a real estate development company that makes a capital investment with a credit income. What we're doing is the same thing with Bitcoin, and we want to make sure that the market understands that. But if I was being more precise, I'd say never be a net seller of Bitcoin. It just wouldn't have been so viral or so catchy to say never be a net seller of Bitcoin. I think that in these periods, even if we were to sell 1 Bitcoin, we'd be buying 10 to 20 more Bitcoin. So you're really talking about a situation where we buy 10 Bitcoin, sell 1 Bitcoin, buy 9 net Bitcoin, and continue to accrete Bitcoin. It should be a non-issue after people understand it, but right now it's a colorful area of commentary. So the number 1 Bitcoin accretion engine is Stretch. We sold $3.2 billion of STRC in April. So we bought $3.2 billion of Bitcoin. The dividend is about 80 to 90 million. So in the month when we're raising $3 billion, we need to come up with $80 or $90 million to pay the dividend. So you would be, in essence, you would be buying 30 Bitcoin, selling 1 Bitcoin, right? Our break-even rate is 2.3%. So what that means is that if we sell Stretch, if we issue Stretch credit equal to 2.3% of our Bitcoin holdings, then that means we will be a net buyer of Bitcoin forever, even if we sell Bitcoin to pay the dividend. Another point is that if Bitcoin appreciates 2.3% a year, we can pay the dividends forever, right? And continue to grow value, right? And we can do it without selling any common equity. So the break even is 2.3. Right now we've sold about $5 billion of STRC in the first 4 months of the year. So we're running on a pace to have an issuance rate of 15 or 20% this year. 2.3% is the break even. So you buy 20, you sell 2, you net 18, right? The company, as long as it grows, is going to buy more Bitcoin than it sells. I expect we'll be a net buyer of Bitcoin in every month and every quarter, going on forever.
For years, Michael Saylor built his entire public identity around one phrase: never sell your Bitcoin. To millions of investors, it sounded almost religious, a hardline philosophy built on absolute conviction. Which is why his latest comments caught so many people off guard. Because beneath the surface, Saylor quietly revealed something much more sophisticated than blind Bitcoin maximalism. He's not talking about worshiping Bitcoin. He's talking about strategic capital allocation in a world where fiat currency is slowly losing integrity. Most critics hear the word sell and immediately assume weakness, panic, or betrayal. But Saylor's argument is almost the opposite. In his view, Bitcoin is not a collectible to lock away forever. It is productive capital. If selling 1 Bitcoin creates the conditions to acquire 10 more later, the network effect becomes stronger, not weaker. That idea sounds controversial until you compare it to how the largest corporations in the world already operate. Companies constantly issue debt, buy back shares, rotate assets, and exploit market inefficiencies to strengthen long-term positioning. BlackRock, sovereign wealth funds, and institutional allocators do this every day. Saylor is applying that same logic to Bitcoin treasury strategy. The deeper implication is what makes this conversation so fascinating. Saylor may not be abandoning the never sell philosophy at all. He may be redefining it for a future where Bitcoin becomes the core collateral of the global financial system itself.
A lot of investors believe this never sell your Bitcoin religiously, right? And do you think they should still follow that suggestion?
Yeah, I think that you should be a net accumulator of Bitcoin. Like when I say never sell your Bitcoin, I mean, make sure that if you were to spend it on something, you replenish it in the time you spend it. So there are also a lot of crypto people or a lot of Bitcoin people that say they want to spend Bitcoin to buy things. And if you were to spend Bitcoin, I would say just replenish the Bitcoin. So you don't want to be a net seller of Bitcoin because Bitcoin is capital. You want to end every year with more Bitcoin than you started the year. And the analogy I'd give you is if Google spent $1 billion to invest in data centers so that they could make $10 billion, they're making net $9 billion. It wouldn't crash the dollar market, right? Oh, Google spent dollars. Google sold dollars to buy data centers. The dollar would be fine. It wouldn't undermine the Google business model. Oh, they spent $1 billion to invest in their business. That's fine, right? And so it'd be fine for Google. It's a rational thing to do. Sometimes you spend money to make more money. So if you're spending 1 Bitcoin to make 10 Bitcoin, I think it's fine for Bitcoin. I think it's fine for the company. I think it strengthens our company because if our company has the ability to tap the crypto liquidity market, if we can raise liquidity by selling spot Bitcoin, that's a $20 billion spot market and a $50 billion derivative market every day. That's a powerful energy source. So we want to be able to tap that market when the equity capital markets aren't as liquid as the commodity market for Bitcoin. And so whenever a company strips its options, whenever we say we will never do something, we always regret it, whatever it is. Give you another example, right? If we say we would never ever buy our stock, we would always sell our stock, then short sellers would sell our stock and they would sell it down to $1. The stock trades at a big discount to NAV, we would buy it back. Then the short sellers have something to lose, then we would make a lot of money by them being irrational. And so what we did say in our earnings call yesterday is we're prepared to trade stretch for the common stock. We'll trade STRC for MSTR. We'll trade BTC for MSTR. We will fund our obligations with BTC or MSTR. We'll do whatever's in the best interest of the company. But, over time, we expect to be a net Bitcoin accumulator. That doesn't change. The way that we trade our assets day to day, whether we sell credit or sell equity or sell capital assets, that will be a function of the market and mispricings. And if, the other thing we said yesterday is we're ready to buy our bonds back. So our corporate bonds trade cheap. They're undervalued, and so it makes sense for us to buy them. It doesn't make sense to sell them. So we don't sell assets that are undervalued. We buy assets that are undervalued, and then we arbitrage whatever the inefficiency is. And if the market knows we're going to do that, then the market's going to actually fairly value all those assets. And that's to the benefit of all the investors and all those instruments. And ultimately, that's our fiduciary obligation.